What's going on, everyone? It's Steven. Sunday night, and I'm looking at a lot of my customer emails from over the weekend. And a lot of people were talking about what happened on Friday. So there was a big spike in volatility, shot up, and then it came all the way down. So a lot of people have been hitting me up and saying, Steven, what do we do in those cases? How can we protect ourselves from stocks going down? Should we be buying the VIX? Should we be buying UVXY or VXX? So we're going to go ahead here. We're going to get in the computer typing. I don't know if you guys can hear me typing, but we're going to get in the computer and we're going to talk about actually why you should never buy UVXY or VXX and why you're just doing a huge disservice to yourself in doing so. So I will see you guys inside the computer. All right, everyone, we are inside the computer. Again, the title of this video, Why Investing in UVXY and VXX is a Bad Idea. And one of my funny photos of myself on the right. You'd be sad too if you knew how much money you're missing out on. Actually, thinking about it now, that's probably not an accurate saying right there. If I had to do it again, it would be based off of UVXY and VXX. It would be, you'd be sad too if you knew how much money you're losing and how much they're ripping you off investing in UVXY and VXX. And I promise you, while I'm saying now that it's a bad idea to invest in UVXY and VXX, I promise you, if you watch this entire video, and it shouldn't be too long, if you watch this entire video and you actually listen to what I'm saying, you will never, ever again invest in UVXY and VXX, and you'll be very happy to never do that again. So let's dive in. So why invest in UVXY or VXX? Well, people believe, and this is an inaccurate statement, and we'll get to that in another video, but people believe that if you get long volatility, you protect your downside. So when stocks go up, in order to lock in those gains or protect your downside, you want to buy protection, whether being in the VIX, which again, if you haven't seen my first video on what the VIX actually means, go back. But the VIX is not an indicator of fear or risk. The VIX is just a 1-year expected move in the S&P 500, right? But people buy protection in the VIX so that when stocks go down, if the expected move or the VIX goes higher, the value of those options that they purchase go up. Thus, you mitigate some of the losses you would have already had. And again, that's for a whole nother video of why that's not a great idea either. But that's kind of the first reason people would be interested in buying UVXY and VXX, to protect your downside, right? So if we go to the little Analyze tab here, let's go UVXY, we'll see it's the ProShares Ultra VIX Short-Term Futures ETF. Right, so this obviously will mimic the price of the VIX to a multiple. And the same thing with VXX. This is the Barclays Bank iPath S&P 500 Short-Term VIX ETN. So the way to think about them is that UVXY is a 3 times VIX, VXX is a 2 times VIX. So obviously if you time it perfectly, the idea is that you will make money or you will mitigate some of the losses that you would have normally had when stocks go down. Pretty simple. The second reason why someone would invest in UVXY or VXX is because you cannot actually invest in the VIX. So again, the first video that I had on this channel talking about how high or low the S&P 500 can go in 2018 was all about the VIX. It was all about the VIX, and it was talking about how we could use the VIX to predict price movement, because the VIX, again, is not an indicator of fear or risk. The VIX is just the 1-year expected move in the S&P 500. Right? So again, one of the reasons why you might invest in UVXY or VXX is you cannot invest in the VIX. So I'm going to go to Apple real quick. And I want you to see on Apple, there were 40 million shares traded on Friday. Let's say Microsoft, there were 29 million shares traded on Friday? Let's see Snapchat. There was almost 20 million shares traded on Friday. Facebook, there were 20 million shares traded on Friday. But when we go to the VIX, we see 0 shares traded, right? You cannot invest in the VIX because the VIX has no stock. You can only trade options on the VIX. Now, what that means is the VIX is cash settled. So when we go back to Apple, we see that there are 40 million shares traded on a given day. In fact, if we dig a little bit deeper, Apple has about 5 billion shares to it. Any of these options in Apple, they settle to stock, right? So if you have an in-the-money option at expiration, you will be assigned stock. However, if we go back to our friend the VIX, you'll see that the VIX has 0 shares. You cannot get assigned any stock here because there are no shares. Thus, the VIX doesn't settle to cash. If you have an in-the-money option in the VIX, you don't get assigned any stock because, again, there is no stock. There are no shares. Everything gets settled to cash. So the VIX is a cash settled index. Thus, you can't buy or sell VIX. That's why people get interested in UVXY and VXX because there are shares. So UVXY traded about 95 million shares, right? And there are about 36 million shares overall. And VXX traded about 106 million shares on Friday, and there are about 15 million shares. Again, that's why people are interested in buying UVXY or VXX because you can buy the stock, right? There's no bid or ask here. You could buy the stock. You can't buy the stock of VIX because there is no stock. Everything settles to cash. Right, so those are kind of the reasons why people like to invest in UVXY or VX. And finally, it's kind of sexy, right? You could read about it online. There's a ton about VXX, UVXY. They talk about it all the time on CNBC and Bloomberg. So it's something that's talked about a lot. So this is why people are interested in UVXY and VXX. But what do the VIX, UVXY, and VXX look like? So again, the VIX is cash settled. There are no shares, right? But UVXY, again, UVXY has 36 million shares. Their options settled to shares, and you can buy and sell shares. Same thing with VXX. You can buy and sell shares here. However, again, VXX, you cannot do that. On a chart, this is what the VIX looks like. So the VIX, up, down, but it looks like it has somewhat of a floor to it, right around that $9, $10 area. It looks like it has some sort of a floor to it, right? So the VIX goes up and down, but it never goes down infinitely so far below 8, 9, or 10 that it gets so close to 0. It doesn't actually happen. However, when we look at UVXY over the same time frame, we look at the high of 214 and a low of 1268. This looks a lot different than the VIX chart. Remember, the VIX chart has very much a floor to it, where UVXY does not have a floor. It looks like it goes down in perpetuity. So in the times when the VIX is actually just sitting there, UVXY is going down. And the same thing can be said for VXX. The high of the year for VXX was 112. The low was 30. So clearly here, we can see there's a major difference in VIX, which again has somewhat of a floor to it as compared to UVXY, which doesn't really look like it has a floor, and VXX, which again doesn't really look like it has a floor. The UVXY and VXX look like they just go down to the right, and even when they go up very, very marginally, where the VIX, again, has that floor to it. So they look incredibly different. Thus, their price movements are incredibly different, which makes a lot of sense. So the question is, then why do they look so different? if UVXY and VXX are put there so that you can make money when volatility goes higher, and again, they're put there because we cannot buy stock in the VIX, we can only buy stock in UVXY and VXX. Why do they look so different? Remember, they're supposed to mimic volatility. I mean, look at the name of VXX. It's a short-term VIX ETN, right? It's the short-term this. So why do they look so incredibly different than one another, right? Well, there's some realities that we have to talk about. First, UVXY and VXX do not get their price from the VIX. And I'm sure a lot of you out there have been guessing that so far. And again, UVXY looks like this, and VIX looks like this. So it's pretty obvious that UVXY and VXX do not get their price from the VIX. Now, they have to get their price from a true asset. And since the VIX is not really an asset in terms of there's no stock, remember there's no stock in the VIX, it has 0 shares, and VXX and UVXY have to get their value and their price from a true asset. And again, since VIX is cash secured, does not have any stock, they have to get their price off of something else, so they get their price off of something known as the VIX futures. So what are the VIX futures? Well, the VIX futures are futures contracts where speculators get to speculate or bet on the price of volatility at a later date. And they also use this product to hedge their stock positions, right? So we don't want to get too much into futures right now. But what we could see is there is a VIX futures contract. And what we kind of looked at earlier, which is really, really interesting, is the title of UVXY is the ProShares Ultra VIX Short-Term Futures ETF. So this is really even more validation into the fact that UVXY and VXX get their price off of the VIX futures, right? Here's what the chart of VIX futures look like. But this is kind of interesting. The chart of VIX futures, they actually look pretty similar to the VIX. Loading, loading, loading. They look pretty similar to the VIX. And look dissimilar to UVXY and VXX. But if UVXY is the ProShares Ultra VIX Short-Term Futures ETF, that's a tongue twister, and it doesn't look a thing like VIX futures, what's really going on here? Maybe there's more we need to look into. So again, VIX futures look like the VIX, but not like UVXY and VXX. So why do they look so different? Well, we need to dig in a bit. Now, one of the things I want you to notice is VXX, VIX, they look like they have a floor in them. UVXY, on the other hand, doesn't look like they have a floor in it. VXX does not look like they have a floor in it. It looks like they have this drag against them no matter what. That even when volatility goes higher, right? Even when volatility goes higher, these ETNs, UVXY and VXX, they barely even move, right? They barely even move. So why this drag? Well, the VIX futures, similar to all futures contracts, have something called contango, which happens 80% of the time. Contango is the reason why we feel like when we look at the chart of VXX or UVXY, it just looks like a drag. Contango is the reason why. And what contango means, because again, futures contracts, there are many different contracts where we have something like UVXY, which has, again, it has 36 million shares, and it never goes to zero. We have something, the VIX futures, that have different contracts that expire at different times and different days. You can see This contract expires 3 days from now. This contract expires 24 days from now. So they have different expirations. And don't worry too much about the VIX futures and futures contracts. Don't worry about that too much. But what contango means is that the contracts furthest away from expiring are priced higher than the ones closest to expiring. So what we could see here is the contracts that are further away from expiring, the one 31 days from now is priced at $12.45. However, the contracts that are priced as closest to expiring 3 days from now are priced lower. That's what contango is. And again, remember, contango occurs 80% of the time. So this is the reason for the performance of UVXY. This is the reason for this ugly drag, this nasty drag that doesn't happen in the VIX and doesn't happen in the VIX futures. It only happens with UVXY and VXX. Contango, which happens 80% of the time, which again is the futures contracts that are further away from expiring being priced higher than the future contracts closest to expiring. And again, that happens 80% of the time. That's the reason there's a negative drag in UVXY and VXX, right? Because those ETFs, UVXY and VXX, remember, they get their price from VIX futures. Right? Again, the name of UVXY is ProShares Ultra Short Term Futures ETF. So let's move on. So here's an example, the screenshot of what you guys just saw. Right? You guys just saw here with VIX futures. What we see here is we have 5 contracts. And just like 80% of the time, currently the VIX futures are in contango. How do I know they're in contango? I know they're in contango because the price of the contracts furthest away from expiring, 31 days, are priced higher than the ones closest to expiring, 3 days, 11.30. So that's a little bit over $1 difference. That's $1.15 difference, right? But again, how does something that looks like this, that's priced off this, end up looking like this? Right, we know contango happens 80% of the time, but how does it really work? Well, let's break this down a little bit and let's take our time with it. UVXY and VXX are managed by different companies. I think one of them is managed by Barclays. I have no idea what the other one is managed off of. And again, they have to get their price based off of an asset. There is no stock. There is no stock for the VIX. Thus, there's no real asset for UVXY and VXX to get priced off of if it was priced off of the VIX. Thus, the next closest thing to the price of the VIX, what's the closest thing to look like this? VIX futures has a real asset because there are actual futures contracts to buy or sell. That is what gets the price of UVXY and VXX. Now, what these managers do is they hold a basket of VIX futures contracts at any given time so that the value of UVXY and VXX are priced off of the value of how many futures contracts they have and blah, blah, blah. So let's say right now that UVXY is made up of 100 of these VIX futures that expire in, let's say, 3 days from now. So what will happen is, let's say they get 100 of them. And this isn't accurate because a value of a VIX futures contract is far more than $11.30, but it'll just be easier to explain this way. So let's say the value of each futures contract, VX49Z7, is really $11.30, and we have 100 of them to make up UVXY. That's about $11,300. Now, what happens is these futures contracts will they will stop trading. They're done. They're fairy dust 3 days from now. So in order to keep UVXY alive, they have to move the contracts that they have in the expiration cycle that expires in 3 days and move those contracts to later dates. So let's say at any given time, there are 100 futures contracts in UVXY. Right now, they're all valued at $11.30 times 100. So again, $11,000, 300. But in 3 days, these are going to be non-existent. And they have to maintain UVXY, so they have to move the contracts from one month to another. Now, this is where the contango thing kicks in. Because contango happens 80% of the time, and because contango means the prices of the futures contracts expiring at a later date are valued higher than the contracts expiring at a sooner date, in order to move those contracts from an expiring day or contract to one further out that expires later on, the fund UVXY and VXX, they have to take a loss on that trade. That is why there's a negative drag, because in order to even maintain the ETF, they have to take a loss for doing so. Remember again, because VIX is not an asset, it's cash secured, so there is no stock. So they can't create UVXY and VXX based off of X amount of shares of VIX. That doesn't exist. So they have to do the next most closest thing that tracks volatility. Those are the VIX futures. And because the VIX futures are in contango 80% of the time, and because UVXY and VXX are priced off of the VIX futures, there's a negative drag 80% of the time to VXX and UVXY. So we could see here, if we have to roll, that's what we call when we move a futures contract from one date to another, that's called rolling. Let's say we want to roll it to the expiration cycle 31 days from now. That's that's $115 loss. That's about a 1% loss on the entire value of UVXY just to maintain the ETF, just to keep the ETF from going to zero, because the contracts expiring in 3 days will no longer be a thing. So you can see here, looking at this chart down here, that 80% of the time, UVXY has to devalue itself just to maintain the ETF, just to keep it alive. So that is how you get something that's supposed to look like this, and it ends up looking like this. Because again, just to maintain people being able to buy and sell UVXY, the managers of the fund have to take a loss because of the contango that happens 80% of the time. That's some pretty serious stuff, guys. So if the market doesn't go down big quickly, you will see UVXY and VXX have this negative drag because, again, the price of the futures contracts further out are going to be higher priced than the ones closer. So UVXY and VXX, again, they have a negative drag against them 80% of the time. So the question I have for you is, although they talk about it on CNBC, although you've read articles about it, although you can buy any amount of stock you want in UVXY and VXX, although they do occasionally go higher when stocks go down, why would you buy them? Remember, they have a negative drag against them 80% of the time. You have a disadvantage. You have a monetary and statistical disadvantage against you if you buy UVXY or VXX 80% of the time. So you wouldn't ever buy them, / you won't ever from moving forward. So most of the videos that I'm going to have on this channel end with a way for you to make money based off of what we're talking about. However, in this case, we're not going to get into it on this video. So what can you do now? Well, for starters, you can never buy UVXY or VXX. Just don't do it. And again, we'll get into it in later videos about how we can get long volatility and protect ourselves if stocks go down. But for now, as a rule of thumb, and you have a new rule of thumb, write it down, put it wherever you need, put it in your phone, send yourself a text message, whatever it is. Never buy UVXX or VXX. Now again, why is that the case? That's the case because 80% of the time, VIX futures, which UVXY and VXX get their price from, are in something called contango. Contango means the price of the futures contracts further away from expiring are higher price than the ones closer to expiring. Thus, in order to maintain the ETF, in order to keep them alive, UVXY for example, in order to keep UVXY alive and not just go to zero, they must move the futures contracts further away from expiring, and in doing that, they have to take a loss, and that happens 80% of the time. And because of that, you're at a disadvantage, a big disadvantage. How big of a disadvantage? That much of a disadvantage, 80% of the time. So never buy VXX or UVXY, and look out for later videos on exactly how you could capitalize on stocks going down. And it's not going to be buying VXX or UVXY. So I'll see you guys in the next video.